Good morning, everyone, or good afternoon from wherever you are joining us. It's a pleasure to be having the session this afternoon with you. Most of you know me already, and from Sanlam Private Wealth based here in Mauritius, and we are having our quarterly update today where we'll look at global markets. Our last update was in October last year, and since then, so much has happened on the global markets and in the AI portfolio. With me here today, I have Jorge Gutierrez, whom all of you've met before in our previous session. Jorge, welcome. Good morning to you, and it's a pleasure to be having you with us today to go through what the AI portfolio has done, how the market, how we ended the year 2025, and how it started year to date. It's already 2 months into Q1 of 2026. So we're looking forward to the session this morning. So in terms of the format of the session, we'll keep it as exactly the same as we've had previously, so 20-25 minutes. And then if you have any questions, please don't hesitate to pop them through the chat or reach out to me, and we'll take it from there. Jorge, good morning to you. I know it's quite early on your side of the world. Thank you for joining us.
And good morning. Thank you. No, I love early starts to the day. So thank you so much again for hosting this webinar. It's a pleasure to speak with you, and obviously all of Sanlam Private Wealth clients. I think these quarterly updates are important in light of what you just said. Lots of events, lots of things happening in the markets and the geopolitical. So we'll try to cover that in the next 20-25 minutes, sort of a summary, and provide a highlight of how the AI ETF portfolios have performed and what we can expect with some sort of guidance. So that is the expectations for this morning. But definitely lots going on. Many positive things. A couple of things in the horizon to look at, but overall, I think the message is positive, and it's a continuation of what we discussed in our last call, where we made the appeal to where we're going to have robust growth in not only the U.S. economy, but in the global economies. And I think that continued throughout last year, where it provided very good performance in strong markets. And I think we can see a continuation of that. And so I'll talk about some of those things, policy guidelines from the United States and central banks and so forth. So let me put on the presentation, and then we can begin. And you can see the presentation. Yep. Okay, perfect. All right. So in terms of the agenda, if we look at the agenda, this is sort of the things that we touched on last time. We start with the global economy. We'll look at growth, inflation, monetary policy, what a central bank's doing. That's sort of important. Then we'll look at the U.S. economy as a proxy for the world economy, which it follows. So we'll look at labor markets, interest rate outlooks. We'll take a look at where the fixed income markets, bond markets, treasuries, and so forth. We'll look at equity performance as well, where we look at valuations, and then geopolitical and policy risks. And that's the sort of the main things that we sort of see on the news every morning when we wake up is, tariff policies in the United States. What does that mean to the world? What is the impact? And we can see that. The rise in gold prices, I think we've seen how gold has had major resilience in the decline of the US dollar. So we'll look at that, and then we'll finish off with the AI portfolios. And we'll look at some performance and some key metrics and highlights. So in terms of if we look at the global economic overview, sort of 6 main things to look at. We look at global growth. We look at the inflation or disinflation trend that we've had really since the end of COVID, where we had COVID, and then we had this significant increase in global inflation, and we see the prices of goods increase significantly. Now the opposite side, we're on the other end, where we've seen price decreases, and we'll look at inflation metrics. And so that in turn then translates to, well, what are the big central banks doing? The Federal Reserve, the European Central Bank, and so forth. And what we've seen is a decline in interest rates, which is positive for the markets. The decline of the cost of money decreases. That's very positive for credits. And also it has an impact on the US dollar. So we'll talk about that. Fiscal policy remains very strong in terms of the United States. All of the impact of the One Big Beautiful Bill that President Trump passed last year, which aims to reduce regulation for the banking system. That in turn will create additional credit, will free up credit for the global markets. We see that as a positive thing. On the things to be concerned about is the U.S. debt to GDP that continues to increase. And so I think there's some things that also we have to start taking into consideration for the next couple of years. Geopolitical risks is a continuation of last year's conflicts with Ukraine, Middle East. Very active. It changes almost on a weekly basis. And so what is the impact on the global markets? And probably the most important one is artificial intelligence, AI, and productivity. And this is being driven really largely by the LLMs, large language models that have really significantly increased probably in the last, I would say in the last 12 months, in the last 6 months, in the last 3 months, even in the last month, just significant increases. We're seeing some incredible innovation in the of AI with the advent of ChatGPT or all of the other big tech companies coming up with their own AI solutions. And it's interesting because we've been managing AI portfolios with AI since 2017. So we're one of the oldest, I think the oldest manager in the world, where we introduced artificial intelligence into the management of portfolios back in 2017 when it wasn't discussed. And now this is the main topic of conversation where we're utilizing these tools almost on a daily basis, and the impact around the world and productivity is going to significantly increase. We see some of the things that are going on in robotics with Tesla, with the big leading tech companies, that the impact it could have on productivity and so forth. So that's the main thing. And I think that translates to growth, that translates to opportunities. And so we'll touch on that as well. So in terms of inflation, if we just look at the consumer price index, this is the chart that we have on the screen, and it shows a decline since 2022. So we had COVID in 2020, where obviously we had that huge impact on the markets. Then you can see that line significantly increased in 2021, that inflation, the CPI almost went to 7%, things that we haven't seen probably in 30, 40 years. The excess monetary printing that had occurred to assist all the global markets created this inflation. And so I think what we've done is we've talked in the past calls to say, well, is inflation decreasing? And it's evidence that inflation is decreasing, as we've seen in 2023, 2024, 2025. And we continue to see that it may level off, but it's within the range of the Federal Reserve, which is very, very important. So it's within that 2 to 3% range, where the Federal Reserve has indicated that they will continue to decrease rates. We also have a new Fed president coming in here in the United States, Federal Reserve president coming in May, which one of his aims is to continue to lower interest rates. So we have to see inflation. If inflation continues in this downward trend, then it's very positive for the markets. It could be positive for it could be another positive year. And then if we look at, because of that decreasing inflation, then we can really see what central banks have been doing, right? So we can see the chart on the right. It's the 5 main central banks in the world, and it's short-term interest rates. We have the U.S. Federal Reserve, the Bank of England, the European Central Bank, the Bank of China, the Bank in Japan. And we saw that increase in inflation at the end of 2022 2023, we see that sharp rise in interest rates, and that really was designed to cut off that 7% inflation number. And since then, we've seen a decline in inflation, so we've seen a decline in interest rates. So it's very positive where the line is trading, where we saw the current rates today in the United States are 3.75%. That's the rate that banks lend to themselves, which is a significant decrease from about a year ago, where it was 4.5%. So if that trend continues, it's very positive for the markets. If we look at the AI and the capital expenditures index, so this is the tax CapEx expenditures. This is what companies spend on technology. And we can see the growth year over year since 2020 to 2024, but really has exploded in 2025 and 2026, where these very large tech companies are investing, major budgets into AI. We saw that Microsoft invested $100 billion into OpenAI, into ChatGPT. So we significant increases, and not only we see the OpenAI, but we see the other 5 leading AI solutions. So it's sort of an arms race to who's going to lead the AI, the large language networks models to capture market share. And so what this translates to is if there's additional CapEx expenditures, additional investment, that translates to productivity, that translates to jobs, that translates to growth. So we can see a continuation really of last year's market, where the S&P and all the equity markets really finished off way above trend. And we could continue to see that, we may continue to see that this year as well. So we can see that sort of the year over year 2025 capex growth 67%. We can see that sort of for this year, for 2026, expected $650 billion. So significant investments into this space. Amazon alone is targeting $200 billion in capex expenditures. Alphabet or Google, another $185 billion. Microsoft, $145 billion. So major capex expenditures, and obviously Goldman Sachs over $1 trillion over the since last year going into 2027. So in terms of not Goldman Sachs, in terms of everything that we've seen in capex. So this is probably one of the most important impacts in the not only the U.S. economy but in the global economy, where we've really seen this big tech spending, and that's really translating into growth. And if it translates into growth, it translates to stock performance, equity performance, and then obviously that's where the AI portfolios aim to achieve, to participate on this uptick. So what we sort of see, for the next quarters of, the chart on the right, we look at GDP growth, and we've seen GDP growth since 2020. And the forecast for this year and for next year. So we see growth sort of near 2%, which is very good. At a certain point, I remember, several calls ago, we were talking about a soft landing or a possible U.S. recession. We never got there. We never reached those levels where growth continued at a very steady pace of 2% or above. And what we expect is we may have surprises on GDP growth to the upside. We may have more growth than we anticipate. And this is largely driven by all this AI tech expansion. And obviously by interest rates as well. If we see, if interest rates decline, that's really the cost of money, cost of capital for big companies to borrow, to spend, and so forth. So we have GDP annual growth rate last year hit 2.5%, which is, again, it's above consensus, which is very good. We see low interest rates. We see labor productivity. So we really have many of the catalysts that are working in favor for the markets, and what we've seen last year and we will continue perhaps to see this year. Again, sort of to hit on this productivity growth that we've seen because of this new AI era. If we look at back since 2015, so if we look back at the last sort of 10 years, 10, 12 years, we can see this index, CapEx index and productivity growth really increasing. So we saw that at the end of 2024, and then it's really picking up. It's picking up because of these main things. We have lower interest rates that fueling investment. We have the CapEx GDP multiplier. We have corporate margins, profit margins expanding. And then probably the last bullet point is sort of this reshoring infrastructure, President Trump's big move for big companies to bring back productivity into the United States, which big companies have made big moves and commitments into this realm. And so we've seen the results in that, and it's positive for the equity markets. So if we look at sort of a snapshot of where the U.S. economy is and interest rates, we see that interest rates have declined. See that core CPI, the inflation index, is within range. It's up in the higher end of the range, 2.9. If we continue to see that inflation number decrease, that's going to be very positive. And then obviously that trends to growth in the overall U.S. economy. And I focus on the U.S. economy because that sort of leads the global economy. So it's important to keep an eye on not only the U.S., but the overall economies around the main economies around the world. So what do we expect? We expect that perhaps the rates are going to decline two more times this year. There's the risk that the interest rates may stay higher for longer because of inflation. So if inflation continues to moderate, we should see this now. If it stays within this range, then we can live with this. We can live with this federal funds rate. We can live with this interest rate. It's very accommodative. Labor market remains very tight, meaning that the unemployment rate in the United States remains low, which that could impact inflation at some point as wage will increase, and that could be inflationary. But the consumer spending picture remains very, very resilient. And so in that aspect, overall, we have a very good scorecard from inflation and from overall growth. So in terms of what we look at the fiscal policy here in the United States and in Europe, we've mentioned that inflation decreases and it's decreasing, so that's a positive thing for the overall markets. We saw also inflation in Europe is also at 2%. In the UK, inflation is a little higher, 2.6, but again, it's within range. And so that's what we wanted to see. We wanted to see a decline in inflation, because that's what led central banks to increase rates. And that's what really, when we were talking back then, it was about recessions and soft landings and hard landings, and that never came about, which is a very positive thing. Now, the big things to watch is obviously the tariffs. We've seen that President Trump has moderated on his sort of tariff argument. We have elections this year in the United States. We have congressional elections where the House and the Senate will be up for votes. And so I think we'll continue to see this moderating posture from the tariff picture. So, but that's one of the main things to look at. Energy prices have eased. We saw obviously the involvement of the United States in Venezuela and the impact on oil. So oil prices have declined. We're seeing that there's negotiations between the United States and Iran, and so that's positive catalyst, because obviously it's going to affect the oil markets in that region. So we have some sort of positive tailwinds in that factor. What are some of the concerns? The concerns in the United States, it's this deficit projected, which is 6 to 7% of GDP, which is high, and then the debt, which is probably one of the main concerns. The U.S. debt hitting 36 trillion, and this is one of the main reasons that President Trump has advocated for lower rates. If the interest rates decline, then the service on that debt declines, and that helps the budget. So that's one of the main things. And then we also see in the productivity gains, the potential tax cuts from Congress from the bill that was passed last year, which represents tax savings for corporations, which again, that could have a positive catalyst on earnings in the United States, on earnings globally, really around the companies internationally. And then in terms of the European Union, we've seen that they sort of reinstated the fiscal rules. So again, being very proactive with their budgets. We see Germany increasing their expenditure on infrastructure and defense, which again is a positive catalyst. We see as a positive impact for Europe and for the European Union. Just a quick snapshot on where interest rates are, not only in the United States. So we see the Treasury rates, the 3-month Treasury rates, the 10-year Treasury rates is 4%. And we've seen the impact on performance of bonds across the world. So one of the biggest probably outliers that we saw was emerging market local currency bonds really had a very strong resurgence, very strong market, up almost 20%. And this is on the back of it where the dollar declined, right? So we have the dollar, the US dollar index declined. And so that really propelled a lot of these emerging market currencies to appreciate. And then you overlay that with high interest rates in those markets, very strong markets there. We have very strong markets in not only that, but also in the high yield market. So overall, very strong snapshot from the fixed income world again, and this is being led by interest rates declining. So when interest rates decline, bond prices rise, and so that's been a positive catalyst, and we see the effects on that. In terms of the equity markets, if we look at the S&P 500, what we can see is the S&P finished off another strong year last year, up 17, almost 18%. This is followed, by the increase in 2024, 2023. 2022, obviously, we had a big decline, but in 2021, we had a big increase. So for the last 4 or 5 years, the S&P has risen, has very strong results, very strong performance. And not only here in the United States, but also if we see the MSCI EFA, which is Europe, Asia, Far East index, that was up over 31%. We saw that emerging markets rose by 33%. So overall, very strong markets across the globe. This is being, again, dominated by AI and technology, where we have big CapEx expenditures, as I just outlined. And then obviously earnings growth and some of the big sectors that have done very, very, very well. So we continue to see that. Switching over to where we see sort of the main things on geopolitical reason and regulation, U.S. trade policy. So as sort of on a higher risk, we have to see what this continuous of this tariff policy will have on key trading partners here in the U.S. We see that at some point the Ukraine-Russia war will have to come to the negotiating table, and they have to come up to some sort of settlement. And we see that probably a high probability that will happen sometime this year. Middle East tensions, a lot of things going on in the Middle East. There's negotiations, and so I think one of the main things that the world has managed to avert, a major crisis in the Middle East, and that's obviously impacting oil prices, where oil prices have decreased. In terms of regulatory and policy changes, we see that regulation has decreased here. It's letting banks to lend more into the economy, which is very strong for the markets. And then probably, the biggest concern is this fiscal and debt levels for the United States, which we discussed, and the dollar index. We've seen the dollar index had very, very weak in the first part of last year. It rallied, but we see the impact on that. So we sort of see the dollar index for the last 3 years, and we see the trend on that since 2023. We see this big decline in the value of the dollar really in the first half of last year, where it declined 10%. We usually don't see these big declines in the U.S. dollar, but we had it, and then it recovered in the second half. But it was a very, very big decline there. And this presentation, I'll forward it to Anne so she can pass it on to everyone, and you can read some of this information at your leisure. The other thing that gets discussed, oil prices. The oil prices in 2020, last year in 2025, increased 27%. So big increase in oil. We can see this chart here, how gold prices were rising steadily. Then it really had a break away this year. What's leading to this increase in gold? Well, it's central banks are starting to buy gold at a very high rate. We have this sort of geopolitical uncertainty with Ukraine, Middle East. So it's sort of a hedging mechanism, and is to hedge into gold. One of the things that the AI portfolios does allocate into gold in a very tactical way. So we've managed to capture some of this upside in gold prices. Also by the Federal Reserve decreasing rates, that sort of puts the dollar on a weaker position, and that's led to this increase in gold. So what do we expect gold prices? We may expect gold prices to continue to rise. We're not sure that's going to continue to rise at this pace, but we continue to see, nonetheless, we continue to see that gold may continue to rise as well. As sort of a quick snapshot, I want to finish off with the AI portfolios. So again, the AI portfolios, it's a very different solution that we have in the market. So we have this predictive investment engine that was developed by AI machines back in the early 2010s. We incorporated, and these portfolios became live in 2017. So we've been managing these portfolios now for almost 8 years. So we saw that in. And in terms of the AI portfolios, it goes to a very structured, comprehensive complex where it goes through 3 phases, where really the computing power of these portfolios is significant. Where we have, I'll highlight some of the things where we have, 600 AI digital traders evaluating every index, evaluating every ETF. And so that's a big differentiator in the marketplace where data is king and where information is power. So the ability to harness those 2 things translates to performance. So why is this our Prospero AI portfolios different from sort of the main discretionary portfolios that we see in the marketplace? Sort of a handful of items, variables that we see that, in terms of decision basis power, the AI models are running largely on self-learning algorithms based on a lot of data, which translates to unbiased decisions. And the biggest thing is that the portfolios recalibrate on a weekly basis. So they're taking in live data on a weekly basis, and they're seeing what is the most optimal outcome for that following week, and they will position the portfolio. So in a risk-on environment where we see the equity markets rising, you want the best exposure to go into those markets. But on the inverse side, if we see volatility, and again, it's taking in data on a weekly basis, if we see volatility heighten or we see some uncertainties, then the portfolios do have the ability to provide a risk-off structure, which is to increase cash, to increase fixed income, and to avoid capital loss. So rule number one is avoid capital loss. But if you do participate in capital loss, the idea is to get back into the market. And so how does it do it? Well, it does. It has all of these tools in the toolkit that create big advantage versus traditional portfolio managers, and we see the return. So what does that translate to? Well, that translates to performance. So if we sort of look at for example, the Prospero AI Growth ETF portfolio, since inception, since 2017 to finish off in 2025, the portfolio rose 145%, a significant increase. If we see that on a just last year on 2025, we had a 17% return. So the S&P 500 returned 17.9. This portfolio returned 17.2 with much less volatility. So it almost gave us equity-like returns, but it has bonds in there, it has cash in there, and it outperformed the benchmark. It outperformed the benchmark not only last year, but if we see sort of this outperformance, 1 year, 3 years, 5 years, we have significant outperformance versus the respective benchmark. So this sort of very consistent performance on a 1-year basis, 3-year average, almost 24% in the last 3 years. In the last 5 years, over 10%, and since inception, since 2017, 70%. So very strong performance. And this is on the flip side, in terms of what we see, volatility, low volatility, where we have the standard deviation, which is a measure of volatility, 11%. And so that translates to very good risk-adjusted return numbers. So we have sort of the AI ETF suite. We have the AI growth portfolio, the AI balanced portfolio, the AI conservative portfolio. The only difference in the three is how much equity exposure can you have in each of these portfolios. So the AI growth is going to have more exposure to equities, and where the AI conservative is going to be more defensive, it's going to have less exposure. But if we see the performance for last year, across the board, very strong performance. If we look at the last 3 years on an average annual basis, 24% for AI growth or 17% for the balanced portfolio, even the conservative portfolio up over 9%. And we can see the performance since inception. And then also not only looking at performance, but looking also at volatility and risk-adjusted performance. So that's the bottom half of the screen. And we can see that very strong performance in those measures as well. What does the positioning look like? As I just noted, these portfolios change on a weekly basis. So the allocation is going to change on a weekly basis, which makes them very tactical, very robust. And so we can see sort of a snapshot of where each of the portfolios were invested. And if we look at the main position, so it was invested in the Invesco QQQ, which is the NASDAQ, which is largely technology. And we've seen how technology has led the market for the last 3 years, right? So if we continue to see this CapEx expenditure, that's going to translate to equity growth. And so we want exposure to those markets. And so so systematically provides exposure into that equity market. But as I mentioned, it also has exposure into gold. It has exposure into fixed income as well to neutralize volatility and so forth. So the biggest thing is utilizing cash as a risk-off instrument, which is very different from traditional portfolios. So we can even see the cash allocation. Again, this is a snapshot for 1 week, but we can see the cash allocation for the AI growth to go up 37%, or even the AI balanced portfolio to go up 57%. And this is a couple of weeks ago when the markets had a correction, or not a correction, the markets declined for that week. And so we see how tactical these portfolios are and how this solution is. And then sort of to finish off the commentary, we can see the performance. And again, I'll just select the AI growth portfolio versus its respective benchmark. We can see this consistent outperformance. The consistent outperformance year over year, maybe underperformed in 2022, but consistent outperformance year over year, which you don't really see in the markets. In fact, there's a statistic that that 93% of all portfolio managers underperform their benchmark, where we see here that the AI portfolios consistently outperform their benchmark, and this is true for the AI balance and the AI conservative portfolio. So with that, Anne, I think I was trying to keep it within. Let me finish off some sort of the key takeaways and the outlook for this year, which is probably the most important part of this conversation. So on a macro level, we see the economy continue to increase. We really have no recession fears or recession concerns going into this year. So we may see we may see growth to the upside. So we may see surprises to the upside. That's going to be very good. We see rates again continue to decrease. So that's very strong. We have really equity momentum, specifically in the large caps of the large companies, and that translates not only in the US but around the world. The main things is obviously I think these geopolitical risks are gonna be managed themselves, and the number one risk is tariffs and so forth. But I think that's gonna ease as well. And then lastly, as I mentioned, the AI ETF portfolios finished off another strong year, not only against their benchmark but against other comparables. investments. So with that, Anne, thank you so much for your time and allowing me to share some of these thoughts with Sanlam Private Wealth. I always enjoy these presentations, and again, we're always available for any individual questions or individual conversations or presentations with any clients that they may want to go into a little deeper with some of these topics.
Thank you so much, Jorge. I really appreciate the presentation.